Facing an unprecedented energy crisis, countries across Europe and the UK are drafting plans to help consumers and businesses. The consequences will be hard and the costs high. In February, Russia launched a full-scale invasion of Ukraine. That put the brakes on Europe's easy access to Russian energy and sent the price of oil and gas rocketing. Those high prices helped stoke record inflation across Europe this summer. And with energy prices set to rise higher still, the UK announced a plan to help keep people's costs under control. When Russia invaded Ukraine, the hope was that it'd be a short-term, failed endeavor, that economic sanctions would swiftly pressure Russia to stand down, and that energy prices would fall back to normal levels. That didn't happen. The war rages on, and after maintenance on the key pipeline from Russia threatened Europe's gas supply, the taps were ultimately turned off. With truncated supply, energy prices are already higher. And with winter approaching, rising demand means they'll likely go higher still. Energy's a pretty non-negotiable cost. You need it to heat your home, to cook, and to charge your phone. And businesses literally need to keep the lights on for their workers and customers. People are at risk of not being able to pay their bills, and companies are at risk of going bankrupt. Germany is putting up about $100 billion in support so far. But Europe's hoping to do more. Countries are discussing a potential limit on what they'd pay for Russian energy, which would help countries balance the books better and offer people some certainty. The UK's gone a step further. Last week, it announced plans to pay the difference between consumers' current energy costs and whatever they rise to over the next 18 months, essentially capping their energy bills. Some $170 billion of new borrowing has been earmarked to pay for this, but the actual cost could prove much higher if energy prices continue to climb. 1. A negative, self-reinforcing spiral could begin. Governments will be spending to help cover consumer and business energy costs, and to do that, they'll be selling bonds to investors. The higher interest rates of the day will mean governments will face steeper debt costs than before. And what's more, new bonds will increase the amount out there, meaning there's more debt in the market compared to the size of the shrinking Eurozone and UK economies. That'll likely give investors pause about buying in. Others might ditch the bonds altogether, and that could weigh on the value of the euro and British pound. 2. If you can't beat them, buy them. There are countless natural gas ETF whose price tracks that of natural gas, allowing you to potentially profit if prices rise. Since energy commodities are in tight supply, you not only benefit from capital gains, but this will also provide steady dividends and diversify your portfolio.